Hello, everyone. Welcome to New Wave Media. And I'm joined today by Ammar Anis Malik, who is a senior research scientist at William and Mary College. In particular, he works with the Aid Data Lab, which compiles and researches on international aid flows across the globe. Thank you, Ammar, for joining me. The reason, Ammar, I asked you to join me on a Sunday is that I recently read a report that was published by your lab, by William and Mary a Data Project, wherein it was an astounding sort of conclusion that China had given out $240 billion to governments in the developing world, in what is called emergency loans over the past 2 decades. And Bloomberg, that reported on the basis of the data collected by you, said that this total surpassed the $144 billion that the IMF data shows its members have drawn from the Washington-based lender during that time. And the bulk of the Chinese assistance was during 2016 to 21, a 5 years period when 22 countries got $185 billion. So this is astounding, to say the least. What it also shows is the rising sort of power of China, and perhaps the emergence of an alternative to the Bretton Woods system that we know since the Second World War. So, but before we go on to these questions of implications, I would very much like Ammar to tell us about this new report and its details. What does it say globally about Chinese assistance to developing countries?
Thank you very much, Raza, for inviting me. I think before I come to the specific findings of this particular report, I'll spend a couple of minutes giving some background. Back in 2008, 2009, when the US Treasury rates of return fell down dramatically as a result of the financial crisis, China, which had a lot of its investments in US Treasury bonds, started to look for more bankable projects. And there was a huge surge between then and the announcement of the Belt and Road Initiative in doing project financing around the world. So these were big ticket infrastructure projects like railways and highways, the plants that China would invest in. Announced in 2013, there was another surge led by President Xi's vision for growing China's global influence. And then we saw even more financing of big ticket infrastructure projects all the way until the coming of COVID-19. So already countries who were on the receiving end of Belt and Road projects were up to their eyeballs in debt, and they were taking on more and more debt in order to finance these infrastructure projects. Now, what this report has shown is, for the first time, it has uncovered evidence systematically putting together reports from publicly available sources to say that China has been doing two major things, particularly, as you said, in the last 5 or 6 years. One is it is extended through the People's Bank of China, which is its central bank. It is extending a line of credit loans or debt swaps. And second, China is also giving short-term liquidity loans to developing countries. The total project size, the lending size, is 240 billion, as you said, 170 of which has gone through debt swaps, and 70 through short-term lending. And it is not a coincidence, Raza, that the majority of this money is actually going into countries which are middle income, large economies like Pakistan and Argentina, and countries which are large recipients of Belt and Road projects and are having trouble repaying the debts that they had incurred during the Belt and Road era.
Right. Very, very interesting. So Ammar, also tell me, you explained that how, because one of the key questions is that, how does China raise these funds? You briefly mentioned that. So just explain a little bit for an average viewer, who may not be technically savvy as you are, perhaps. So,
It's actually very simple. Anybody who's gone out shopping anywhere in the world, whether it's in the West or in the developing world, you see that China sells a lot of things around the world. They are a manufacturing powerhouse, and they run massive trade surpluses, which means they export a lot more than they import. And that means that they hold a lot of foreign reserves in their bank account. So as early as 2006, they were touching almost $1 trillion in reserves, and today they are at around $3 trillion. That is a lot of money that you have to keep in your reserves. But most countries, because of macroeconomic reasons, try to invest those funds into investments that would yield a return. And that is the fundamental reason why China has been trying to make good use of those funds by lending to countries who are in need for it, and also lending to countries who will eventually become their friends and allies around the world. So it serves both the geostrategic purpose, but also the macroeconomic objective.
yes. And, before, because I would also like to talk a bit about Pakistan, the country where we are from. That would be of interest to me, and I'm sure many of the viewers who would hear your commentary. Also, just explain a little bit, who are the top recipients of the Chinese largesse? I mean, you mentioned Argentina. I suppose Sri Lanka would be one, Pakistan would be one, Zambia, I remember reading in the report. I mean, just a couple of countries so that we can also see where this Chinese influence is sort of growing, you know?
If you're talking about the bailout
Yeah,
style lending, then
rescue loans.
rescue loans, exactly. The authors of this report call it bailouts on the Belt and Road, and that is because these bailouts are directed at Belt and Road countries, and they are directed at 22 countries who are mostly middle income economies. Egypt, I would add, is also another one. Pakistan has probably been the favorite. We've counted over 20 instances where they have received big rescue loans in both of these forms. And so what the strategy appears to be, focusing on countries which are large economies who have large Belt and Road portfolios, and countries which are having trouble repaying the loans that they had taken between, let's say, 2008 and 2017-18. And in a way, you can think of this as a strategy of China to try to bail out or try to keep afloat their own banks, because remember, the lending is coming out of China. So it's basically a case of the right hand trying to give money to the left hand to keep the system running. And essentially, China is betting on the fact that these are not solvency crises, these are liquidity crises. In other words, that these countries just need a small bridge to overcome a crisis that they're facing, but in the long term, they will come good with their economies. But the challenge is rather that I don't think that a lot of countries that they're relying on are going to be solvent in the future because of a lot of different factors that we can discuss.
Right. So tell me one more thing that I think needs some explanation is that what if these countries are sort of defaulting, let's say at some point, or do not repay the debt or the interest or whatever, what methods do the Chinese have to sort of sanction them or ensure? Because I mean, we know that Bretton Woods operates in the international financial system where they have all these ratings and all these other instruments where they can sort of sanction a country, so to speak. But do Chinese have a method or a process whereby they can, take some punitive actions if countries are not paying back? I mean, this is a lot of money, hundreds and billions of dollars.
Yeah, Raza, when we looked at the Belt and Road projects in particular, we found that as far as the largest projects are concerned, I would say the 40 out of the 50 biggest projects have collateral. And China's favorite strategy is not to take collateral on illiquid assets, the way that is portrayed by Western media as a debt trap. they want liquid assets. And we have found that they have conditions in their loan agreements. We have published 100 of them on Data's website under a study called How China Lends. We find that these are escrow accounts. So in other words, countries are required, or borrowers are required to maintain a minimum cash balance that the creditors can debit on a moment's notice. These are called set-off rights in banking parlance, and it's a very common strategy that commercial creditors have employed. What we are seeing is that China is using that mechanism to protect themselves. In Africa, in resource-rich countries like Angola and the DRC, we are seeing resource-backed loans where the loan is given out for a mining operation, and the minerals that are sitting inside the mine, they themselves become the collateral, or the way that China will perhaps get repaid, and get repaid with interest on time. And also we are seeing that none of these loans are fully transparent. In other words, we don't know fully well the terms and conditions of these, but China does not participate in the Paris Club. So in other words, when a country goes on to a default-like situation, like what we are seeing in Sri Lanka, China may or may not participate in a coordinated debt rescheduling, which creates a lot of problems. In other words, the question is, who will be the first in line to get repaid if a country like Sri Lanka or Zambia, or God forbid, Pakistan might be struggling to repay its debt? And chances are that because of this opaqueness and these non-disclosure clauses, that China may have positioned itself to be ahead of the repayment line as compared to the Paris Club creditors.
Oh, okay, that's interesting. So anyway, let's come back to the main question about the Chinese role. So I mean, we know that Pakistan has been seeking bailouts from China. I mean, just recently, I think Pakistan received $2 billion because of the delay in the signing of the staff level agreement with the IMF. And so tell us a bit more about how Pakistan is now part of this debt ecosystem of the Chinese sort of global economic power.
So it is true that China has established a pretty large network of countries, or a system through which they have the ability now to bail out countries. The debt swap agreements that I was talking about, they are denominated in RMB, which is the Chinese currency, and they already have in place agreements between their central bank and 40 other countries to bail them out. So it appears on the one hand that China has established an elaborate system of bailing out countries, and the immediate implication of that, as is being discussed as a result of Data's recent report, is whether China is going to stand up a system that is an alternative to the IMF and provides bailouts like the IMF does. And then in the case of Pakistan, I think it really helps us clarify China's behavior. I was watching a seminar last week where the Director General of the International Department of the Chinese Central Bank was saying that China will not enter into the business of providing economic policy advice to countries that receive its money. So for example, even now, China has given Pakistan $2 billion to let us have a little bit of a breathing room, given our exchange foreign exchange reserves are being so low. But China is still focusing on the multilateral institutions to do the dirty work of providing economic policy advice. You can see how much IMF is portrayed as a villain in Pakistan, and it is because they're forcing the government to make some very difficult decisions. And China is playing smart. They're going to stay behind the scenes, support the multilateral system as it stands, and then make sure that they are not the ones ahead of the IMF giving Pakistan advice to raise fuel prices, because that would be an absolute disaster for China's approval ratings in Pakistan, which are very, very positive. China is very popular in Pakistan. So their strategy very much is, we're going to remain behind the scenes. We have this alternative system. We will give bailouts to countries when we see fit. But publicly, they are continuing to take the position that countries who are in fiscal distress should remain in good standing with the IMF, and only then will China continue to engage with them. In fact, Data uncovered a unredacted agreement between the Chinese central bank and the Argentinian government, in which they explicitly put a condition on their credit line extensions to Argentina by saying, we will continue to help you so long as you're good with the IMF. And I think that's what's happening in the case of Pakistan as well.
Right. That's exactly what I wanted to also know, and I think you preempted me. Is that that China is also effectively using the Bretton Woods for the kind of piggybacking, as they say. Let the IMF impose conditions. Let it ask for all the prior actions to be done, and then so in a way, well, it's very interesting that while it is a parallel sort of a lender of last resort, but it also works with or uses that system to its advantage. Am I correct in reading that?
Yeah, I think they're playing it very smart. And similarly, they're also using their the status of an economic powerhouse to increase their influence on the multilateral system. They are also creating large trust funds with the IMF, with the World Bank, with the Asian Development Bank, with African Development Bank, to get into the business of co-financing large projects. So I think that the Chinese strategy is, from their vantage point, is smart. However, Raza, they're also facing a big challenge. So if you look at the portfolio of Belt and Road projects, take a look at this statistic. So in 2010, only 5% of China's overseas lending portfolio was directed at countries which were in debt distress, according to the IMF, just 5%. Today, that number has gone up to 60%. So if you're a policymaker in Beijing and looking at the world, there is a lot of red lights flashing at you. And this is why I think China's strategy of giving out these bailouts, I think in the moment they seem to be working, but as countries continue to have current account deficits, as commodity prices remain high because of the war in Ukraine and other factors, I think they are eventually going to have to get into the business of reprofiling, restructuring debt. And that is where the whole issue of whether China coordinates with multilateral systems and takes haircuts come into place or not. The big deadlock that has emerged in recent days is that the Chinese are insisting, in the case of Sri Lanka, that if they're going to take a haircut, which means that they're going to give like a little discount on the loans that Sri Lanka is unable to pay, they want to have equal treatment across the table, which means they also want the World Bank and the IMF to take similar losses. Whereas those institutions have insisted that because they maintain AAA ratings in the international credit system, that they are not in a position ever to go down that route. So I think that kind of showdown is bound to happen. And as I heard Raza Bakir say the other day on a podcast, the last thing Pakistan would want is that this China-US rivalry or this disagreement between China and the multilateral system that plays out in an IMF boardroom while they're discussing a bailout for Pakistan, God forbid, that would be an absolute disaster.
But do you think that is the case? If something like that is happening, given that the IMF agreement with Pakistan is so delayed, and for months and months they've been negotiating, and Pakistan has already taken many of has implemented most of the actions that the IMF recommended. Leading to a historic level of inflation in the country, burdening the poor and the middle classes, and yet there's no staff level agreement.
Yeah, this is because the lack of staff level agreement, as we all know, is because of the lack of financial commitments from our friendly countries, which are supposed to promise $6-7 billion of liquidity in the short term to make sure that after the IMF program comes, that Pakistan can keep going in that fashion. And there is a active debate right now among Pakistani economists as to whether debt reprofiling or debt restructuring in Pakistan is inevitable, or can Pakistan just continue to take more and more and more loans, new loans, and keep the old loans as they are and keep rolling over the swaps or the short-term loans that they've taken. So if the big debt restructuring takes place, I think the transaction cost of having all parties come to the table all parties be in agreement on what that will look like, and whether the comparable treatment clause, which is a hallmark of the international financial system, whether that extends to China or not, and what China will do and what Saudi Arabia will do and how they will behave. I think that's going to be a big question mark. So I think it might be in Pakistan's interest to keep taking new loans, short-term loans to weather this storm. But my worry is, again, the point that I was saying earlier, there is a solvency crisis that Pakistan faces, and those fundamental economic reforms that Pakistan needs to take, I think those will need to happen. If we delay those, then this time when this sort of thing happens in the IMF boardroom, as I was painting this picture, I think that is going to become more and more a greater likelihood. At the moment, I would say we are in between a rock and a hard place. You go ahead, you are in trouble. You go back, you're in trouble. So it's a very, very difficult situation, and Pakistan is not the only country.
Right, right. So anyway, Ammar, thank you so much for joining me, and I think I have learned quite a bit about this process of China's sort of ingress into the developing world. But I think we must continue our conversations, and perhaps I'm going to request you again to join about the data that you have been collecting and analyzing, because that is something that we often lack in the mainstream popular discourse, evidence. And I think we need to always keep that as the central sort of basis for our decision. So anyway, thank you for joining me, and let's talk again. Goodbye.
My pleasure, Raza. Thank you very much for your time.